Good morning, San Antonio. My name is Caleb Janosek. I'm an audit manager here with ADKF, and today I'm here with Tyson Gaenzel, an audit partner, and we're here to talk to you today about construction accounting. So I guess the first question someone might have is construction accounting similar to accounting for other businesses? Are there differences?
It is in some ways, and the primary difference is in revenue recognition. So most construction contractors recognize revenue on a percentage of estimated cost to total cost in the job at that point. Okay. You calculate a percentage, you multiply that by the contract revenue, and at the end, you're going to get whatever revenue you have earned for that period, and that's what you will recognize.
Okay. So Tyson, are there any other ways that a construction company can recognize revenue?
There are lesser used ways. So there is the completed contract method, where the contractor has to wait until the project is fully complete before they can recognize that revenue. There's also the milestone method. So when certain milestones are hit, the contractor will then recognize revenue.
Okay. So Tyson, what is the most critical factor in recording revenue using the percentage of completion method?
Job cost estimates. So estimating the total cost of that job at the beginning of the project and then any revisions as you've gone along is the most critical part of revenue recognition using the percentage of completion method. If you don't have an accurate job cost, you're not going to recognize revenue correctly, and you're not going to know how much it's going to cost to finish the job.
Gotcha. So Tyson, what happens when a contractor doesn't charge enough on a job?
If they don't charge enough on a job, they'll record an asset for cost and estimated earnings in excess of billings. That's a number that ends up on your balance sheet at whatever the amount is calculated. Mm-hmm. It represents basically a loan to the owner of the contract. So I'm lending money to them. I've paid for whatever the materials, the labor that went into this job, and I haven't charged them for it. So as a contractor, from a cash flow standpoint, we need to manage that number. We need to make sure we're not putting too much into a job, because that's our cash that we're providing to the owner of the contract that then we're paying interest on, or we're not getting the ability to use in some other way.
Right. And from a cash flow perspective, you want to stay on top of your billings as well.
Yes, sir.
So then what happens if a contractor charges too much on the job?
If they charge too much on a job, then you'll have a liability, and you're going to owe the owner of the contract back for whatever work you have not performed yet. So from a cash flow standpoint, I'll have the money in the bank and everything looks good. And I may get excited that I have a bunch of money in the bank. But the contractor can't forget that they owe this work to this individual. So whoever owns the contract is expecting us to go out there and do that. So if it's coming to the end of the year and for tax planning purposes, you're like, I can go buy some equipment with this money. Be careful, because you don't want to overspend that money, because you still have to perform the work.
Okay. So Tyson, what is included in a construction contractor's financial statements?
A construction contractor has many of the same financial statements that a for-profit business will have. So it's going to have a balance sheet that lists the assets and the liabilities. It's going to have an income statement that is just a combined statement of what you've earned during the year. It'll have a statement of owner's equity to show contributions, distributions, your net income, any equity type activity.
All the usuals.
It's also going to have a statement of cash flows that lists how money came in and went out of the organization during the year. The one critical difference is the supplemental schedules that go in the back. So there is going to be a schedule of completed contracts and a schedule of uncompleted contracts.
Okay. So of those statements, which one would you say is the most important?
If the balance sheet and income statement don't have anything strange on them, the organization's made some money, the balance sheet has more assets than liabilities, it comes down to the supplemental schedules. So those schedules of completed jobs and uncompleted jobs are critical. It's going to show profit on those individual jobs. It's going to show billings in excess and cost in excess of billings. So what your asset and your liability is there. And more importantly, it's going to be a way for users of the financials to see how you bid your jobs.
Okay. Tyson, thank you for the information. Is there anything else you want to include for today?
For construction contractors, it comes down to cash flow and managing that cash flow, and they always need to be aware of that. So that's why those job cost estimates are so important, and your billings are so important. And how you structure that contract on day one, and it may be a 18-month contract, day one figures how well you're going to do on that job. So having that forecasting ability and that ability to estimate your cash flows within that is critically important for construction contractors.
Gotcha. That's excellent information. Appreciate your time today, Tyson, and we'll catch you next time.
Thank you.